Hey, welcome to Exchange. Let's talk about Redfin right now. They're in a weird spot right now with housing interest rates rising. Also, too, their portfolio overall is getting a lot more diversified. So they actually might be in a good spot potentially for a buy. Let's take a look at it. So this is the current Redfin stock, trading about $16. Dropping pretty fast. I mean, obviously, growth stock's been hit pretty hard. And they are really a growth stock. They trade like a growth stock. But one thing to notice here is from 2019 levels, they're about $17 and $20. I mean, they're actually below that level. They're actually pre-COVID levels, pre-stimulus, everything else. I mean, they're actually dropping far below that, which is kind of surprising me. That's why I actually did this video. I first saw that. We saw highs there basically last February, $96. I mean, this stock's been absolutely annihilated looking over the past year or so. I mean, the question is how much farther will it actually drop? But let's look at the financials. So this is a model built up of Redfin's financials, and really what you have to do to break it down is really revenue streams, break it down by various revenue streams. It's almost like a conglomerate in a way where it's like almost separate businesses combined together and make up the revenue stream as a whole. So the very first one is brokerage and partner revenue. So that's the most common thing you see there. So brokerage revenue, basically what they do, their model is commission rates are typically 1.5%, which averages 3%. So they're like a discount brokerage firm for buying and selling houses and properties in general. They also have a partner revenue stream there, which partner revenue stream, all it means is like third party partners come in and they basically get a cut of that partner sales, of partner integrations, etc. Properties, this is the iBuying network. This is like the most controversial area of their entire portfolio. So basically all properties are this whole line right here is basically institutional house flipping. So almost think like fixer-upper style, where they come in, they buy older homes, and then they fix them up for like $50,000 to $100,000 of renovations, and from there they sell them for a profit, ideally for a profit. That's the properties revenue stream. Rentals is actually very, very exciting for them. They actually just acquired RentPath, which is a major rental platform, which should be very exciting for them in the future. Hopefully it pays off. So this is RentPath.com, which they acquired last year for $608 million. And RentPath owns Rent.com, Rentals.com, and ApartmentGuide.com, which are three major rental websites for houses, condos, apartments, whatever else it might be. So really that full spectrum ecosystem for whether you want to buy your first house or first apartment or rent your first apartment. I mean, they really have almost a one-stop shop for your entire basically housing needs across the board. So next line is the mortgages. They actually had an in-house mortgage, which is like a team, which is like 13, 14 people. It wasn't that big. It was roughly about $19 million in revenue. They actually just acquired Bay Equity, which is basically another mortgage loan provider. They do new home loan originations as well as refinancing too. They actually got acquired recently. They actually should roll up under Redfin Q2 of this year. We think roughly about $350 million of revenue coming from Bay Equity after that mortgage is complete. We'll see what the actual numbers are, but it's going to be somewhere around that ballpark. It might be a little bit under, it might be a little bit more, but we'll see. So what you see overall is revenue growth. I mean, it's been absolutely dramatic. I mean, it's almost a hockey stick L curve heading straight up right there. From 2020, $800 million, 2021, $1.9 billion. This year, I mean, I think they're going to be about $2.9 billion. I mean, going forward, 2026, I'm seeing about $4.4 billion in total revenue, which is absolutely fantastic. I mean, we look at the actual revenue growth rates, like what's actually happening behind the scenes. Really, the big revenue driver is the properties. So it's basically buying and flipping homes and selling those homes is really the revenue driver. Brokerage partner won't grow that fast. It'll basically grow with the housing market. So as the housing market goes up or down, it'll grow or shrink with that. Rentals will grow, but it's a small base right there, so it's obviously not going to be as dynamic as the other areas there. Mortgages is the one area where it could grow pretty fast or it could stay pretty steady, but we don't quite know. We don't have that data just yet for Bay Equity when it rolls up under, so that'd be interesting to see. But this is definitely very interesting. So looking at cost revenue, the next piece, and really what you do is break it down by basically business segment and look at this business segment. So the first thing to look at really is the gross margins. So real estate services, 33% gross margin. I mean, it's pretty healthy. I mean, it's very, very solid. That's kind of their old legacy business they've had for years and years and years. And the really surprising part is the iBuying business, properties. So 2020, negative 2%, 2021, 1%. I mean, it is just absolutely atrocious. So you think about this high cash, and this is a high revenue business. The problem is it makes no money on the front end. And so which is surprising me. I mean, I knew they were probably pretty low margins because market now is pretty hot, but it's this low. This is bad. This is really, really bad. And the problem right here is you really have this idea of algorithmic buying, identifying homes across the board where you can buy it under value. The problem right now in the U.S., there are no homes undervalued. Every home, basically, whether it's new or old or whatever else it might be, is going up, to the moon right now. It's starting to slow down a little bit though. But I mean, the problem with algorithmic buying like this is you get in a price point where it's a little too high, and all of a sudden you have to put renovations into it. All of a sudden you can't sell it quite for as high as money potentially if the market's slowing down. So it's definitely a change for them overall. So this is an article from last October, November, and basically Zillow quit their iBuying home flipping business, basically iBuying program. But I mean, Redfin, they said, hey, this is existential to us. This is part of our core competencies. We're going forward this almost no matter what, which is kind of surprising because like basically Zillow was deciding, hey, like their forecasting for their algorithms was totally out of whack. They're coming in way over the actual market value for what I mean, they're winning the bids for these houses, but they're coming at such an entry price where they couldn't basically flip them. They couldn't make a profit on it. And it was losing nearly hundreds of millions of dollars because they're operating at a much larger scale than Redfin is right now. The big fear we have right now is if Redfin were to either market correct potentially, or if Redfin somehow gets in the bat, basically buys too high of a price, they're going to be probably $100 million plus of basically bad assets where they can't flip them easily and basically have to absorb that loss, which would be pretty bad for their balance sheet. Rentals business, obviously, I mean, it's not a huge baseline, but it's a huge margin increase. Looking at 80% margin, which is fantastic. This is like your rent.com where you basically have those digital marketing ads, your sponsored listings, etc. I mean, it's basically a SaaS offering almost. It's almost pure profit, which is fantastic for them. So really look at it like here is like the real estate services and your rentals business are really your high margin industries. Mortgage industry, we're expecting roughly about 14% margins there for the mortgage loans or refinancing loans, etc. Which again is fine. It'll be able to cover the expenses there, but the problem is, well, what's going to happen in the future is how fast it's going to grow, and that's really the big question you have to ask yourself. Now, I did highlight this here. So the 2021, they have negative 32% margin on their mortgages. So what Redfin did was a little bit weird. They actually rolled up their mortgages, like loan teams, into their actual mortgage cost there. That's why it's negative 32%. The actual mortgages themselves were profitable, which they were sold off as mortgage-backed securities. But this is why this is so negative right here, which we'll see. This might be negative too. They would do the same thing this year for their mortgage teams. But I mean, it's a little surprising there too. One thing I want to highlight here basically is they have, so last year for properties, they bought 2,000 homes, roughly about $435,000 basically for purchase or for the selling price of those homes. The average home is $346K. So what typically they do is they buy older homes in like nicer or pricier zip codes, typically on the coast, either East Coast or West Coast there. So they're actually getting in. So they're not buying that many houses. The problem is right now is the entrance price. So algorithmically buying these houses from the entrance price is challenging too, because right now, if you have an algorithm, it's basically trained on historical data about probably 40 plus years. The problem is right now we're operating in such a weird market where it's low liquidity. The algorithms really can't define that because they're so far away from the mean right now, where it's hard to identify some of these properties just because the data sets that they're trained on are not really trained on this kind of environment where it's a pretty low interest rate, but it's rising right now. Also, too, you're having this massive, basically flight to the suburbs with COVID and everything else too. So it's hard to really build a data set that actually basically encapsulates that and actually is trained on it pretty well. So that'd be interesting to see. And that's really was Zillow's problem. Zillow's problem was, hey, these houses were worth way too much. Or they're paying way too much to get into them. And they're saying, hey, this is not profitable for us. We're just burning cash at this point, which that's Redfin's big fear. I mean, I model this in a way where it's not as negative as that, but I mean, that could happen too. I mean, these margins for properties could go very negative very fast if they're not careful. So I model gross profit here, which I mean, it's going to be dropping just because the basic product mix is changing overall. So as properties basically increase, which is a low margin business, then rentals and real estate will increase, but not as fast as properties. That's why the margin overall is dropping. I would say it's settling around 19%, which again is not bad. It's pretty healthy. The problem right here, I basically look at the OPEX, operating expenses down here. They're at 26, 27%. I model them down for the 22 to 20% range. This might drop further, but I mean, they can't drop that fast because it's just part of the actual business themselves as they grow. But as it becomes more mature and across its various business segments, hopefully they can drop down to the 15, 20% range. But see, the problem right here really is the OPEX costs are 20%, the gross profit's 19%. So you're still a little bit underwater there. So on an EBITDA level, you'd actually be positive, but on a net income basis, you're still negative right there. So this will be something to watch. It's not as bad as other videos I've done where it's not outrageously OPEX expenses. It's not just growing for the sake of growth. They are pretty smart about it, and they are trying to grow pretty, healthily. But the problem is that once they need to drop this down and make it more sustainable in the future. Which, as you can see here, operating income is very negative. Net income is very negative too. I mean, not crazy negative. I mean, you look at 2025, 2026, 2026. I mean, it's slightly negative, but it's barely negative. EBITDA is very profitable overall. So on an EBITDA basis, it is pretty profitable. But the problem right here is net income and EBITDA are basically split, whereas net income is negative, EBITDA is positive, and also you could have cash problems later on down the road. Not immediately, they're not in trouble for that right now, but 2023, 2024, that could be an issue later on. They either do another bond offering or do another raise, potentially to raise cash for the shortfall. So actually looking at the valuation right here, I threw an EBITDA multiple on it on the valuation. So I got to roughly $15.44. It's a little bit weird because they're basically the properties business is not as, it's basically almost like an asset holding company. It's not as profitable. Whereas if they had a blended rate, I think will be at 15% for 2026. I'm looking at roughly $31 potentially of basically like that's the valuation today, which again is totally fine. I mean, it's one of those things where they're trading about the sweet spot right now. We actually are, I'd say, about fairly valued for where they're at right now. The upside is definitely there. The big issue they're going to have is this property business right here. If there's a correction or even a slowdown in the housing market, I mean, they can get underwater very, very fast in some of the properties, which again, that'd be a temporary speed bump. But like the question is, what scared investors would be a long-term issue, etc. Would iBuying be the future for Redfin, which we don't know. I mean, right now they're saying, hey, gung ho, like all the way to iBuying, good, bad, or ugly, whatever happens. But almost for me personally, I'd almost rather them slow down the iBuying business or even just stop it entirely. I think honestly, if they stop iBuying, it's almost value accretive just because real estate services, rentals, mortgages, everything else are very, very profitable, making healthy profits there. Whereas if they got rid of this, the OPEX is going to drop down a little bit too. And also, I think they'd be well above water for gross profit versus OPEX. Where all of a sudden you see, if you saw a pure tech company slash brokerage company basically take away the iBuying or take away the iBuying's profit or iBuying kind of segment, I think it's worth roughly about $43 right now. So I mean, I really see that as kind of the more value accretive sector of the entire Redfin and portfolio. Whereas properties, I mean, the thing of properties, look at revenue growth. I mean, it's the revenue driver, and it's one of those things where it's like, hey, properties. If you want to drive revenue, you can buy as many homes as you want. You can buy 10,000 homes next year in 2023 and have like a blowout quarter where top line revenue absolutely crushes numbers, and you'd say, hey, we're growing at 150%. You should invest in this, etc. The problem is their cost of revenue is so low, where it's basically just at a point you're just holding cash or burning cash, or making small amounts of profit. Where it's like, hey, is this worth it? And the answer might be just no. So another case to look at here is the property business as a whole. It's not very liquid though too. So in any given one time, about 2/3 of their properties are off the market, basically being renovated and being fixed on or whatever else it might be. And about 1/3 are actually basically for sale across the board. The problem is if the housing market corrects fast, or if we have like even a slowdown where all of a sudden growth goes to zero, all of a sudden they got it way too high and the renovations push that basically that price point even higher. They can't get the cash out of these properties fast enough. That's really where they could get trapped. They could get squeezed a little bit too. And the property business overall is not that big. So really what I see is maybe $100 million of potential, like basically of a net loss in the property segment overall. And that could be a very painful lesson. That's why I think Zillow got out. They saw, hey, the future was like, hey, we're burning way too much cash. These renovations are very expensive. Because the thing is like buying properties across the country is totally fine. Renovating properties across the country is a whole different level of too, because they have 100 different business segments across the country. That's like 100 different companies running by themselves. So having your own renovation team, your own contractors coming in, and basically making that optimized, making that efficient across the entire board with supply chain issues across the board. I mean, it's just very, very challenging. That's why I really see the gross profit there as not being that high in the properties business overall, but it is very, very cash intensive. So, I mean, if they absolutely are committed to it, they need to raise mass amounts of debt and just go all in and push it all in if they think they're absolutely right with their algorithms. Or if they're wrong, they just need to, hey, admit that and pull it out the cash, pull out the actual OPEX, and basically from there just stick to the actual high profit, high margin businesses for like the rentals business, etc. And then from there move forward and just make a bunch of money, but not grow as fast. So that's really the trade-off they have right now. I mean, right now they're going growth at any cost right now, which I mean it might work until it doesn't. That's the problem right now. If we have a correction in the next 2022 or 2023. Hey, but definitely let me know your thoughts on this one. Drop a comment down below what you think about Redfin, whether it's a buy or a sell. Also, if you like the video, hit the like button down below. Be sure to subscribe to the channel. That's the exchange.